Why global finance fears stillness more than volatility. Volatility looks dangerous. Stillness looks safe. But history teaches the opposite. This matters today because modern finance has learned to survive chaos, absorb shocks, and recover from crises. What it struggles with is pause. When movement slows, when capital hesitates, when direction becomes unclear, systems grow uneasy. Volatility tests resilience. Stillness tests relevance. The tools built to manage turbulence are useless against immobility, and the skills developed through crisis become liabilities during prolonged calm. To understand why stillness is feared, we need to look beyond price swings. Volatility is information. It signals disagreement, adjustment, and discovery. Markets move because participants are responding. Stillness signals something else entirely. It suggests hesitation, uncertainty without expression, a refusal to commit. London understands this distinction deeply. The city has lived through extremes of chaos and calm. It has learned that violent movement often forces adaptation. Stillness delays it. When nothing moves, assumptions go unchallenged. Capital waits. Innovation stalls. The system begins consuming its own momentum. The paradox is that the very tools developed to manage volatility become useless during stillness because they are designed to respond to signals, and stillness produces none. At first, stillness feels responsible. Risk appears contained. Calm reassures. But beneath the surface, energy drains away. Liquidity becomes selective. Opportunity narrows. Confidence thins not through fear, but through indecision. This is where danger forms. Because systems are built to process motion. They allocate, adjust, and learn through change. Without movement, they lose feedback. And when feedback disappears, direction is replaced by doubt, which is why global finance fears stillness more than volatility. Because volatility can be managed, stillness has to be broken. Stillness disrupts systems in ways volatility never does. When markets move violently, participants respond. Risk is repriced. Capital reallocates. Behavior adjusts. Even fear produces motion. But when movement slows without resolution, responses stall. Decisions are postponed. Signals weaken. The system loses its ability to learn. London has observed this paralysis repeatedly. During prolonged periods of uncertainty, activity does not stop entirely. It fragments. Capital circulates defensively. Liquidity hides in familiar assets. Innovation pauses not because it is impossible, but because it feels unjustified. Everyone waits for clarity that never quite arrives. The waiting itself becomes a dominant market condition, consuming attention and energy that would otherwise drive productive activity. This waiting creates hidden stress. Time becomes a risk. Indecision compounds. Momentum decays. Volatility forces confrontation with reality. Stillness avoids it. The system continues functioning, but without conviction. Processes operate, but direction disappears. Markets drift sideways, consuming energy without generating progress. The resources that would normally be deployed toward growth, innovation, and competition are instead consumed by the maintenance of a holding pattern that produces nothing except a continuation of itself. This is why stillness alarms institutions. Without motion, feedback loops weaken. Models lose relevance. Confidence erodes quietly. Participants cannot tell whether conditions are stabilizing or deteriorating. The absence of movement removes reference points. And without reference, decision-making becomes defensive. London understands that stillness is not neutral. It favors those with scale and endurance. It disadvantages those who need motion to survive. It concentrates power quietly. As waiting becomes strategy, inequality of outcome grows. Those able to sit out uncertainty gain advantage. Others are forced to adapt under pressure. The system appears calm, but it is sorting participants relentlessly. This sorting happens without headlines, which is why stillness feels deceptively safe, and why breaking it becomes necessary before damage becomes irreversible. The conflict emerges when stillness begins feeding on itself. As hesitation persists, participants stop expecting movement and start planning around immobility. Capital is parked rather than deployed. Decisions are framed around preservation instead of progress. The system adjusts inactivity, and in doing so, makes activity even harder to restart. London recognizes this phase immediately. When stillness lasts too long, it reshapes incentives. Taking action feels risky not because conditions are volatile, but because they are unclear. Any move risks being premature. Any commitment risks being isolated. So everyone waits, watching everyone else wait. The collective hesitation becomes its own justification, as each participant's inaction is interpreted by others as confirmation that action is unwise. This creates a silent loop. No signal is strong enough to break inertia. No opportunity feels urgent enough to justify movement. No catalyst feels credible enough to restore direction. Meanwhile, pressure accumulates elsewhere. Smaller participants strain. Projects stall. Innovation dries up. The system continues functioning, but only for those who can afford patience. Stillness becomes a filter, quietly removing those who depend on motion to survive. This is where fragility deepens. Because systems built for flow begin to ossify, rules designed for adjustment begin resisting change. Confidence fades not through fear, but through exhaustion. Volatility at least reveals disagreement. Stillness hides it. London understands that prolonged pause is not stability. It is unresolved tension, and unresolved tension eventually demands release, not always gently. The longer stillness persists, the sharper the eventual adjustment becomes, which is why global finance treats prolonged calm with suspicion, because when nothing moves, something is already breaking. The climax arrives when stillness finally gives way, not through panic, not through collapse, but through exhaustion. A point is reached where waiting costs more than acting. Capital that has been idle begins to decay. Opportunities lost outweigh risks avoided. Participants realize that safety has quietly turned into stagnation, and movement, even imperfect movement, becomes preferable to none at all. London understands this release well. The city does not force motion. It enables it. Small signals appear. Limited commitments resume. Activity returns unevenly at first, then gathers momentum. Confidence rebuilds not because uncertainty vanished, but because action returned. The system begins learning again. Feedback flows. Direction reemerges. This is the resolution of stillness. Not clarity, but momentum. Volatility returns briefly as adjustment takes place. Prices move. Assumptions reset. Some structures strain. But this motion is healthy. It restores information. It reintroduces differentiation. It allows systems to adapt instead of ossify. The lesson is decisive. Volatility challenges systems. Stillness erodes them. Global finance does not fear movement. It depends on it. What it fears is prolonged pause, where uncertainty lingers without expression and pressure accumulates without release. London's enduring role is to recognize when calm has become dangerous, to reintroduce motion before stagnation hardens into decline, and to accept that imperfect movement is often safer than perfect stillness, because systems survive by moving, and when they stop, survival becomes far harder than change ever was. The cost of stillness is measured not in what it destroys, but in what it prevents from being built, and that cost is always invisible until motion returns and the gap becomes undeniable. Subscribe to join the journey. Why?